China sold a record amount of stocks, $5.1 billion in the month of August.
What if the world's second biggest lender to America suddenly decided to pull the plug on every dollar it was owed? It happened. China sells entire U.S. debt in response to Trump tariffs. A headline like that instantly triggers images of markets in freefall, panicked investors, and the world's two largest economies locked in an all-out financial war. The idea is simple but alarming. If China, one of America's biggest lenders, decided to dump all its U.S. government bonds, the shockwaves would hit not just Wall Street, but every major economy tied to the dollar. In 2025, the political and economic backdrop made such a claim feel plausible to many. Donald Trump was back in the White House, reviving his aggressive trade stance toward Beijing. Tariff announcements were coming in waves, targeting everything from Chinese tech products to raw materials. Diplomatic exchanges had grown sharper, and the memory of the first U.S.-China trade war was still fresh. China remains the second largest foreign holder of U.S. debt, hundreds of billions of dollars in treasuries that help finance the American government. That dependency runs both ways, making any sign of weaponizing these holdings front-page news. So, did this really happen? Or is it just a headline built to stir clicks and anxiety? The reality, as the following sections will show, is far more complicated and shaped by deeper market forces than a single retaliatory move. Background: the U.S.-China debt relationship. China's role as a top holder of U.S. treasuries is the product of decades of trade and currency policy. For years, China has run large trade surpluses with the United States, exporting far more goods than it imports. Those extra U.S. dollars didn't just sit in Beijing's reserves. They were channeled into U.S. government bonds, known as treasuries. This served two purposes. It gave China a safe, liquid asset to hold, and it kept the yuan from appreciating too quickly by recycling dollars back into the U.S. financial system. The U.S. dollar's position as the world's reserve currency amplified this pattern. Global trade in oil, commodities, and manufactured goods is largely dollar-denominated, which means treasuries are seen as the most secure and easily traded asset in the world. At its peak around 2013, China held roughly $1.3 trillion in U.S. debt. By 2025, that figure had dropped to about $770 billion. Still enormous, but a notable reduction. For Washington, Chinese investment in treasuries helps keep borrowing costs low, supporting government spending without sharply higher interest rates. For Beijing, treasuries offer stability and predictable returns, while also acting as a tool to manage the yuan's value against the dollar. The relationship, however, has often been overshadowed by tension. During past trade disputes, especially in the late 2000s and again in 2018 to 2019, headlines warned that China might dump treasuries to punish the U.S. Such a move would hit both sides. American bond markets would be disrupted, and China would suffer losses on its own holdings. This economic interdependence is sometimes called financial mutually assured destruction, a reminder that in this high-stakes balance, both players can inflict damage, but neither can escape unscathed. Trade War 2.0: Trump's tariff escalation. By early 2025, the political climate between Washington and Beijing was already tense. Donald Trump's return to the White House brought with it a revival of his hardline trade agenda, centered on the belief that the U.S. had been taken advantage of in global commerce, especially by China. On the campaign trail, he had promised sweeping tariffs to level the playing field, and within months of taking office, those promises turned into policy. In April 2025, the administration announced a new round of major tariff hikes on a broad range of Chinese imports, from consumer electronics to industrial machinery. The message was clear. This was not a symbolic move, but an escalation designed to pressure Beijing directly. Trump's trade team went further, warning that additional levies could soon target Chinese steel, rare earth elements critical to tech manufacturing, and even high-end semiconductor equipment. Beijing's response was swift and sharply worded. Chinese officials condemned the measures as economic bullying and vowed to defend national interests. State media hinted at possible countermeasures, fueling speculation about retaliatory actions that could go beyond goods and into financial markets. The reaction on Wall Street was immediate. U.S. stock indexes swung wildly, with sharp intraday losses reflecting fears of a prolonged trade standoff. In the bond market, yields on U.S. Treasuries climbed as investors braced for higher inflation and uncertainty, marking the first signs of financial stress in what some analysts were already calling Trade War 2.0. The viral headline, China sells entire U.S. debt. Soon after the April 2025 tariff announcements, a new wave of online content exploded across YouTube channels, Facebook feeds, and fringe news sites. It happened. China sells entire U.S. debt in response to Trump tariffs. The formula was unmistakable. Full capital letters, red alert graphics, and urgent narration warning that a financial doomsday had begun. These posts and videos spread rapidly because they tapped into an already familiar storyline, the U.S.-China rivalry escalating beyond trade into economic warfare. The idea of China pulling the plug on U.S. debt fit neatly with public anxieties about global instability and America's vulnerability to foreign creditors. For many viewers, it seemed like the logical next step after years of tariff battles, supply chain tensions, and geopolitical friction. Fear was the accelerant. Economic collapse scenarios are clickable because they play directly into concerns about jobs, savings, and national security. Within hours, the story had gathered millions of views, shares, and heated comment threads. Meanwhile, mainstream financial outlets took a noticeably more cautious tone. Early reports from Reuters, Bloomberg, and the Wall Street Journal referenced modest adjustments in China's treasury holdings, not a full liquidation. But in the race for attention online, that nuance was quickly drowned out by the louder, more dramatic version of events: the reality check. When the noise from viral headlines is stripped away, the official data tells a far calmer story. The U.S. Treasury's monthly Treasury International Capital (TIC) report for April 2025 did show a decline in China's U.S. government bond holdings, but the change was modest. China still held well over $700 billion in treasuries, making it the second-largest foreign creditor to the United States. There was no evidence of a sudden, all-at-once liquidation. Analysts examining the numbers pointed to practical economic reasons for the shift. In recent months, Beijing had been intervening in currency markets to support the yuan, which had come under pressure from capital outflows and slowing domestic growth. Selling a small portion of its treasury holdings is a common tool in that process. Liquidating dollar assets to buy back yuan. This is far removed from a deliberate, politically motivated weaponization of debt. There are also hard limits on the idea of China selling everything. A rapid sell-off would flood the market with U.S. bonds, driving their prices down and slashing the value of China's remaining portfolio. At the same time, dumping treasuries would push the dollar lower and the yuan higher, making Chinese exports less competitive, an outcome directly opposed to Beijing's economic interests. U.S. officials moved quickly to tamp down speculation. Treasury Secretary Janet Yellen stated there was no indication of a coordinated debt dump, and Federal Reserve Chair Jerome Powell called the rumors inconsistent with the actual flow of funds data. Market analysts noted that other countries, along with private investors, were net buyers of treasuries during the same period, offsetting China's limited sales. In short, the reality was far more routine than the headlines suggested. China adjusted its holdings for economic management, not as an act of financial retaliation. The market impact was minor compared to the alarm that gripped social media. The bond market storm. While China's modest treasury sales made headlines, the real story in April 2025 was the broader sell-off sweeping through the U.S. bond market. Yields on the benchmark 10-year Treasury note surged sharply, reaching levels not seen in over a decade. This was not the result of a single player exiting the market. It was a collective pullback by global investors reacting to heightened uncertainty. The trigger was the tariff escalation. Higher trade barriers meant potential supply chain disruptions, reduced global growth, and, in the short term, higher costs for imported goods. Investors quickly priced in the risk of inflation, which erodes the fixed returns from bonds. That anticipation led to selling pressure across the board, pushing yields higher. It's important to distinguish between country-specific actions and a market-wide shift. While China adjusted its holdings for currency reasons, other major holders, Japan, European institutions, and sovereign wealth funds, were also trimming exposure. Hedge funds rebalanced toward shorter duration assets to limit interest rate risk. Large pension funds shifted some capital toward equities and inflation-protected securities. Even central banks in emerging markets were lightening up on treasuries to manage their own currency reserves. The result was a feedback loop. Rising yields spooked more investors, which in turn pushed yields even higher. This kind of market-wide movement is far more powerful than the actions of a single country, even one as significant as China. The bond market storm of April 2025 reflected a global reassessment of U.S. debt in a riskier trade environment, not a targeted act of economic aggression from Beijing. The geopolitical chess game. China's approach to its U.S. debt holdings is part of a much larger, long-term strategy. For over a decade, Beijing has been gradually reducing its reliance on U.S. treasuries, not through sudden sell-offs, but by diversifying into other assets. These include large-scale purchases of gold, investments in Belt and Road infrastructure projects across Asia, Africa, and Europe, and growing reserves in alternative currencies like the euro. This slow rebalancing limits risk while maintaining market stability. When tensions rise, China tends to reach for tools it can control more precisely: targeted tariffs on politically sensitive U.S. exports, export restrictions on critical materials like rare earth elements, and subtle adjustments in currency policy. These measures deliver pressure without destabilizing China's own financial position in the way a massive treasury dump would. Still, Beijing understands the value of perception. Allowing rumors of a debt dump to circulate can create unease in markets and send a political signal, even if no drastic action is taken. It's a form of psychological warfare, shaping the narrative while keeping real leverage intact. The U.S., for its part, has been preparing countermeasures. Policymakers are working to strengthen domestic supply chains in strategic sectors such as semiconductors and clean energy, while also weighing limits on Chinese investments in sensitive industries. Both sides are maneuvering for advantage, but neither is willing to detonate the financial equivalent of a nuclear weapon. Media literacy. The China sells all U.S. debt story is a textbook example of how financial news can be distorted for attention. Online content creators and certain news sites operate in a competitive attention economy, where clicks translate directly into ad revenue. Dramatic, fear-driven headlines, especially those in all caps, outperform measured reporting because they trigger urgency and emotion. This is the "if it bleeds, it leads" mentality applied to economics. A market collapse scenario will always generate more engagement than a slow, technical explanation of bond holdings. Social media algorithms amplify this effect by promoting content that gets rapid shares and reactions, regardless of its accuracy. As a result, sensational narratives can dominate public perception, even when the underlying facts don't match the drama. For topics as complex as sovereign debt and international finance, the only way to cut through the noise is to verify claims against credible primary sources. The U.S. Treasury's TIC data, Federal Reserve reports, and reputable outlets like Bloomberg or Reuters offer a far more accurate picture than unverified videos or headlines. Without this cross-checking, misinformation can quickly overshadow reality. And in markets, perception can move prices almost as much as truth. What do you think was the most shocking news? Let us know in the comments. And if you found this interesting, hit that like button and subscribe for more jaw-dropping stories.